How to read financial statements like a pro. Understanding financial statements might sound intimidating, but once you know how to read them, you'll unlock one of the most powerful tools in business and investing. The balance sheet, income statement, and cash flow statement aren't just numbers on a page. They tell the story of how a company makes money, manages expenses, and builds wealth. In this guide, I'll break down financial statements in simple terms so you can analyze them like a pro, spot hidden opportunities, and make smarter financial decisions. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why financial statements matter. Financial statements are the backbone of business analysis. Whether you're an investor, entrepreneur, or student, knowing how to read them allows you to truly understand the financial health of a company. They're not just numbers. They're a story about how money flows in and out of a business, how efficiently it is being run, and whether it's positioned for long-term growth or possible failure. Investors rely on them to decide whether to buy or sell stocks, lenders use them to assess creditworthiness, and business owners use them to measure performance. The three main types, balance sheet, income statement, and cash flow statement, work together to paint a full financial picture. Reading them like a pro means going beyond surface numbers to analyze trends, relationships, and signals of strength or weakness. For example, a company might show high revenue but poor cash flow, which is a red flag. Or a firm might carry a lot of debt but also have assets that generate consistent profits, making it stable. Without this understanding, decision-making becomes guesswork. That's why financial literacy is a non-negotiable skill for anyone serious about money. 2. The balance sheet explained. The balance sheet provides a snapshot of what a company owns and owes at a specific point in time. It's divided into three sections: assets, liabilities, and shareholders' equity. Assets include everything the company owns, such as cash, accounts receivable, inventory, and property. Liabilities cover debts and obligations, like loans, accounts payable, and accrued expenses. Equity represents the owner's share, which is assets minus liabilities. The balance sheet always follows the equation: assets equals liabilities plus equity. Reading a balance sheet like a pro means looking at the relationships within these sections. For example, comparing current assets to current liabilities gives the current ratio, a measure of short-term liquidity. Looking at long-term debt compared to equity reveals how leveraged a company is. A professional reader doesn't just glance at total assets, they ask, how liquid are those assets? Are inventories turning over quickly? Is debt manageable relative to income? These insights reveal whether a business is financially strong or fragile. The balance sheet alone won't show performance, but it highlights the foundation of stability. 3. The income statement breakdown. The income statement, also known as the profit and loss statement, shows how much money a company made and spent during a specific period. It starts with revenue, sales, and subtracts expenses step by step until net income, profit, is calculated. Major sections include gross profit, revenue minus cost of goods sold, operating profit, earnings before interest and taxes, and net profit, the bottom line. A pro doesn't just check if net income is positive, they dig deeper. For instance, if revenue is growing but net profit is shrinking, it may mean rising costs or poor expense management. If operating profit is strong but net profit is weak, the issue may be high interest expenses or taxes. Analysts also look at profit margins, which compare profit to sales to judge efficiency. A company with thin margins may struggle during downturns. Comparing year-over-year income statements highlights growth trends. Simply put, the income statement reveals profitability and operational strength, making it one of the most powerful tools in financial analysis. 4. The cash flow statement. The cash flow statement shows how money actually moves in and out of a company. Many businesses fail not because they lack revenue, but because they run out of cash to pay bills. The statement is divided into three sections: operating cash flow, day-to-day business activities; investing cash flow, purchases or sales of assets, acquisitions, investments; and financing cash flow, borrowing, repaying loans, issuing shares, or paying dividends. A professional reader examines whether operating activities generate positive cash flow because this indicates a sustainable business. Negative investing cash flow isn't always bad. Buying equipment or expanding facilities may strengthen future growth. Financing cash flow provides clues about how the company raises money. Too much debt financing can signal risk. Cash flow analysis is especially important because companies can manipulate income statements with accounting adjustments, but cash flow is harder to fake. 5. Key financial ratios. To read financial statements like a pro, you need to use financial ratios. Ratios make raw numbers more meaningful by comparing them in ways that reveal efficiency, profitability, and risk. Liquidity ratios like the current ratio and quick ratio measure a company's ability to meet short-term obligations. Profitability ratios such as gross margin, operating margin, and return on equity show how effectively a company turns revenue into profit. Leverage ratios like debt to equity assess financial risk. Efficiency ratios like inventory turnover and asset turnover reveal how well resources are being used. Professionals also use valuation ratios such as price to earnings and price to book when comparing companies. A single ratio doesn't give the full picture, but when analyzed together, they provide insights into whether a business is financially healthy, risky, undervalued, or overpriced. Pros also track changes in ratios over time, since a company might look strong now, but show weakening trends. Ratios turn financial statements into actionable intelligence. 6. Analyzing trends and comparisons. Numbers only become meaningful when compared, either against past performance, trend analysis, or against competitors, benchmarking. A pro doesn't just read one year's financials. They look at several years to spot growth patterns, margin stability, or rising debt. For instance, consistent revenue growth with improving profit margins signals strong management. On the other hand, declining cash flow despite rising sales may suggest weak collections or aggressive accounting. Comparing a company's financial ratios to industry averages also shows whether it's outperforming or lagging. For example, a retail company with an inventory turnover rate much lower than competitors may be struggling with excess stock. Professionals also use horizontal analysis, comparing financial data over time, and vertical analysis, showing line items as percentages of revenue or assets to gain deeper insights. This way, they separate temporary issues from structural problems and uncover the real financial story. 7. Red flags and warning signs. Reading financial statements like a pro means spotting red flags before they become disasters. Warning signs include declining gross margins, negative cash flow from operations, increasing debt-to-equity ratios, or frequent changes in accounting methods. A sudden jump in receivables without matching revenue growth may signal aggressive sales practices or collection problems. Declining free cash flow while profits look strong could indicate earnings manipulation. Professionals also check footnotes and management discussions, where crucial details about lawsuits, regulatory issues, or unusual accounting treatments may be hidden. A healthy company's financials should tell a consistent story across all three statements. Mismatches can be red flags. Spotting these warning signs early helps avoid poor investments or risky lending decisions. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.